For many Nigerians, personal income tax feels confusing not because the rates are unclear, but because people don't understand what income is taxable and what deductions are actually allowed. The new Nigeria Tax Act, 2025 changes that by providing a clearer, broader, and more structured framework for computing individual income. Welcome to A Stitch in Tax Saves Cash, where we simplify Nigeria's tax laws in practical terms that help individuals, professionals, and small businesses stay compliant and legally reduce tax exposure. My name is Olatunji Abdulrazak, founder and CEO of TaxMobile Online, a professional tax knowledge platform supporting taxpayers, tax professionals, and tax administrators across Nigeria and Africa. In today's episode, we are breaking down sections 28 to 32 of the Nigeria Tax Act, 2025, which govern how individual income is computed, what deductions are allowed, and what documentation is required. So, why does this topic matter so much? The simple truth is, many individuals overpay tax. This happens for a few key reasons: failing to claim deductions they are entitled to, poor documentation to back up those claims, and a basic misunderstanding of what counts as taxable income. For years, the informal sector, which makes up a huge part of our economy, has largely remained outside the tax net. At the same time, new income streams from digital assets and investments were not clearly captured. This new law addresses all of that. Personal income tax is no longer limited to just your salary. It now follows the full economic life of the taxpayer. Let's dive into the specifics, starting with Section 28, which is all about your total income. Section 28 introduces a simple but powerful formula. Your total income is your taxable income minus your total deductions. So, what exactly is taxable income under the new Act? Think of it this way: if it increases your economic capacity, the law assumes it is taxable unless it's expressly exempt. This includes the obvious things like profits from your trade, business, profession, or vocation. It also includes your employment income, that's your salary, wages, allowances, and any benefits in kind you receive. Then you have investment income like dividends, interest, rent, and royalties. And crucially, the law now specifically includes income from digital and virtual assets, as well as chargeable capital gains. Now, for the part that saves you money, what can you deduct? From that broad pool of taxable income, you are allowed to deduct a few key things. First, any allowable business losses you may have incurred. Second, capital allowances on your business assets. Third, any income that is statutorily exempt by law. And fourth, any income that has already been subjected to a final withholding tax. The law is also very specific about how losses are treated. You can't just use any loss to offset any income. A loss from your business can only be offset against future profits of that same trade or business. Capital losses are deductible, but they are limited to the actual losses you incurred. And here is a very modern and important rule: losses from digital and virtual assets are ring-fenced. This means if you lose money trading crypto, you cannot use that loss to reduce the tax you pay on your salary or your trading income. Those losses stay within the digital asset category. Next up is Section 29, which introduces the presumptive tax regime. This is a game changer for addressing a major challenge in Nigerian taxation: the informal sector. Think about the millions of informal traders, micro-enterprises, artisans, and self-employed individuals. It's often very difficult for them, and for the tax authorities, to reliably determine their exact income. Section 29 provides a solution. It gives the Minister of Finance, on the advice of the Joint Tax Board, the power to prescribe simplified tax assessments. This could be a small percentage of turnover or another simplified method. It's important to understand that this is not a punitive measure. The goal here is inclusion. It's about widening the tax base in a fair and practical way, bringing more people into the formal system. Now let's move to Section 30, which defines your chargeable income. Your chargeable income is what's left after you deduct eligible reliefs from your total income. This is the final figure that your tax rate will be applied to, so these reliefs are incredibly important. First, You have your statutory contributions. This includes your contributions to an approved pension fund, the National Housing Fund, and the National Health Insurance Scheme. These are direct deductions that lower your taxable amount. Next are reliefs for housing and insurance. If you have a loan for an owner-occupied residential house, the interest you pay on that loan is now a relief. The same goes for premiums you pay on a life insurance policy or an annuity, for yourself or your spouse. But the major innovation in Section 30 is the new rent relief. This is a huge deal, especially for urban taxpayers who face incredibly high rental costs. The law now allows you to claim a relief equivalent to 20% of the annual rent you paid. This is subject to a cap of 500,000 naira, so you claim whichever amount is lower. Of course, this relief isn't just handed to you, it must be supported with evidence, like a formal tenancy agreement and proof of payment. This is a significant relief that directly addresses a major cost of living for millions of Nigerians. This brings us to a critical point covered in Section 31, deductions and reliefs must be claimed. They are not automatic. The law is very clear. You, the taxpayer, must claim these deductions in writing, using the prescribed forms provided by the tax authority. The mindset to have is this: if you don't claim it, the law assumes you don't want it. You can't expect the tax office to automatically know about your rent, your pension contributions, or your loan interest. You have to actively provide that information. And that leads perfectly into Section 32, which reinforces a core principle of tax compliance: no evidence, no deduction. It's that simple. Section 32 is all about the proof. To claim any of these reliefs, you need acceptable evidence. This includes things like your rent agreements and receipts, statements showing your pension contributions, your insurance policy documents, and loan agreements from your bank. Your word is not enough. You need the paperwork to back it up. Now, what happens if your deduction is disallowed because you couldn't provide proof at the time of filing? The law does allow for a correction. If you can provide the necessary evidence later, adjustments can be made. The key takeaway here is that record keeping is no longer just a good habit for businesses, it is now a fundamental personal tax obligation for every individual. So, let's recap the key innovations and their implications. We have a much broader definition of personal income that now clearly includes digital assets. There's the ring fencing of digital asset losses, preventing them from offsetting other income. We have the new presumptive tax regime designed to bring the informal sector into the fold. There are the fantastic new reliefs for rent and housing loans. And underpinning all of this is a very strong emphasis on documentation and evidence. The law effectively balances the expansion of the tax base with targeted reliefs designed to help the taxpayer. What does this mean for you in practical terms? First, keep proper records, even if you're just an employee. Keep your rent receipts, your pay slips, your bank statements. Second, actively claim your reliefs. When you file your returns, make sure you are declaring your rent, your pension, and any other eligible deductions. Don't leave money on the table. Third, if you're involved in digital assets, keep those activities and records separate from your other income streams. And finally, don't assume that pay, or pay as you earn, deducted by your employer covers all your income, especially if you have side hustles, rental income, or investments. Tax compliance is no longer a passive activity, it is participatory. You have a role to play. If this episode has helped you understand how individual income is now computed under the Nigeria Tax Act, 2025, then it has achieved its purpose. The goal is to empower you with knowledge so you can navigate the tax system confidently and efficiently. Please like this video, subscribe to A Stitch in Tax, Saves Cash, and share it with an employee, freelancer, landlord, or small business owner who is preparing for the 2026 tax regime. I am Olatunji Abdulrazak, founder and CEO of TaxMobile Online, and I will see you in the next episode.